All right, let's dive into inventory accounting. We've got a mountain of info here, and it's obvious you're ready to tackle this crucial part of business.
Absolutely. It's exciting.
We're going to break it all down,
Yeah.
from the core principles to the big picture.
Love it.
Think of it like a treasure hunt.
Okay. Yeah.
We're searching for hidden value in every box and on every shelf.
That's a great way to put it. Yeah. It's amazing how often inventory accounting gets overlooked. It's not just about crunching numbers, it's about understanding the true worth of a company's assets and how they impact everything.
Oh, absolutely. Profits, investor decisions, the whole 9 yards.
Yeah, for sure.
So let's start with the basics.
Hmm.
What exactly is inventory? I know it's more than just what you see on a store shelf,
Right. It goes much deeper than that.
but what else is there? Help me out here.
Imagine you're baking a cake. You've got the finished product, the cake itself, ready to go, but then you've also got your raw materials, right? Flour, sugar, eggs, all the good stuff.
Sounds delicious.
Just waiting to be transformed. And then there's the work in progress, like the batter mixing in the bowl.
Right.
That represents all the items in different stages of production. All of that, from the raw ingredients to the finished cake, that's the inventory.
Oh, I see. Okay, so it's like the whole life cycle of a product from start to finish.
Exactly.
That makes total sense.
Yeah.
And that brings me to my next question. Why do we even need standards for how we account for this inventory? What's the big deal?
Well, imagine you're trying to compare two cakes, but there's no standard recipe.
Oh, interesting. Okay.
One might be dense and rich, the other light and fluffy. Same with inventory. Without standards, companies could value things in totally different ways, and then it'd be impossible to compare their performance or really understand their financial health.
So these standards are like a universal recipe,
Yes,
making sure everyone's measuring their ingredients in the same way.
precisely. And they serve several important purposes. First, they ensure accuracy and transparency in financial reporting. This protects stakeholders.
Investors, right?
Yeah.
People who need this info to make informed decisions.
Exactly. Second, these standards promote consistency across different companies, different industries. So it's easier to compare apples to apples.
So it's like a level playing field. Everyone's playing by the same rules. Now, this brings me to another question. How do we actually measure inventory? It can't be as simple as just adding up the price tags on everything, right?
Right. It's much more nuanced than that. The guiding principle is to value inventory at either its cost or its net realizable value, whichever is lower.
Okay, hold on. Net realizable value, what does that even mean? I'm getting lost a little.
Think of it like selling that delicious cake you baked. You might have spent, say, $20 on ingredients, but if the cake gets a little squished on the way to the bake sale, you might only get $10 for it. That $10, that's the net realizable value, what you can realistically get for it considering its condition, the market, everything.
Okay, that's a great analogy. So even if you put a lot of effort into something, its value can change based on all these factors.
Exactly.
Wow, makes you think about those clearance sales in a whole new way. Okay, so this lower of cost or net realizable value, it ensures companies aren't overstating the value of what they have, right?
Precisely. It's about being realistic and transparent.
Makes sense. Now, this is where it gets really interesting, right? Because there's not just one way to value inventory. There's a whole bunch of methods.
You got it. And each one can really impact a company's financial picture. Let's start with the two most well-known, FIFO and LIFO.
FIFO and LIFO. No, we're not talking about pet names this time. Can you break down what those acronyms stand for? What makes them unique?
Absolutely. FIFO stands for first in, first out. It assumes that the oldest inventory gets sold first. It's like when you go grocery shopping and you grab the milk carton at the back of the fridge, the oldest one gets used up first.
Okay, I can picture that.
Now, LIFO, on the other hand, stands for last in, first out, and it assumes that the newest inventory is the first to go.
So if we're sticking with the milk analogy, LIFO would be grabbing the freshest carton, even if there's an older one hiding behind it.
Exactly.
But how does this apply to a company's financials? Why does it even matter which one they choose?
Great question. Let's say milk prices go up. With FIFO, your cost of goods sold would be lower because you're assuming you sold the older, cheaper milk first. But with LIFO, your cost of goods sold would be higher because you're assuming you sold the newer, more expensive milk first.
Wait a minute, so the method a company uses can actually change how much profit they report.
Precisely.
Ah.
Seriously. And this isn't just about milk. This applies to all sorts of inventory. The choice between FIFO and LIFO can significantly impact a company's financial statements, especially when prices are going up and down.
Wow, I'm starting to see how these seemingly small accounting choices can have a big impact on a company's bottom line. What are some of the other methods we should know about?
Another common one is the weighted average method, which, as the name suggests, calculates the average cost of all units. This kind of simplifies things, smooths out the impact of price changes. And then there's the specific identification method. This is for unique, high-value items where each individual piece can be tracked.
Oh, okay.
Think of things like antique cars or rare pieces of art.
I see. So it's about choosing the right tool for the job.
Right.
Depending on what a company's inventory actually is and how they want to manage their financials.
Exactly. Each method has its advantages and disadvantages, so companies need to carefully consider which one is the best fit.
All right, we've got what inventory is, why standards are so important, and a rundown of some of the evaluation methods. But where does all of this actually show up in a company's financials?
You'll find it on the balance sheet,
Okay.
nestled in there as a current asset. This is because inventory is expected to be turned into cash relatively quickly, usually within a year.
So when you're looking at a company's balance sheet, that inventory number is just the tip of the iceberg. The real insights are hidden in the notes to the financial statements, where you'll find all those details about which method they used and other crucial information.
Exactly. Those notes give context, transparency, really help you understand how they arrived at that inventory value and what it means for their overall financial picture.
Now, we've been focused on the technical side of things, but I can't help but wonder, what are some of the real-world challenges that companies actually face when it comes to managing this inventory?
Oh, great question. One of the biggest is definitely those fluctuating prices we talked about earlier. Remember that milk example? If prices suddenly drop after a company has stocked up, they might find themselves with a lot of inventory that's now worth less than what they paid for it.
Ouch, yeah, that's gotta hurt. What happens in those situations?
Well, they might need to do what's called an inventory write-down. It basically means reducing the value of inventory on their books to reflect its lower realizable value.
So it's like admitting that the milk has gone sour
Yeah, kind of.
and adjusting the books to reflect that reality. And these write-downs, they can have a big impact on a company's profitability, right?
Absolutely. So you can see why accurate inventory management is so critical.
It sounds like there's a lot more to this than meets the eye. It's not just about counting boxes. It's about understanding trends, managing risks, and making strategic decisions.
Exactly.
Decisions that impact the entire financial health of the company.
You got it. And as we explore further, we'll uncover even more fascinating aspects of inventory accounting, including how technology is changing everything.
Oh, now that sounds intriguing. Can't wait to hear more about that. But first, let's take a quick pause to digest all this great info. Welcome back to our deep dive into inventory accounting. We've covered so much ground already.
Yeah, it's been a great discussion.
We've talked about what inventory is, those important standards, and some of the methods for valuing it all.
Right.
But you mentioned earlier how technology is revolutionizing all of this. I'm really eager to hear more about that.
It's like we've gone from abacuses to these powerful computers.
Wow, yeah.
Technology is bringing so much to the table. Efficiency, accuracy, insight.
It's incredible.
One of the biggest game changers is cloud-based inventory management systems.
Cloud-based systems. Okay, break that down for me. How do they actually work? I'm picturing like virtual shelves or something.
Think of it like a giant digital warehouse. All your inventory information is stored there, and you can access it from anywhere.
So no more of those clunky spreadsheets.
Nope, no more physical files.
That's amazing.
Everything's streamlined, accessible in real time.
Okay, so it's like a virtual control center for all your inventory.
Mm.
I get it. But what are the real benefits for businesses? How does this actually translate into like real improvements?
Imagine a company with multiple warehouses, maybe across the country even.
Okay.
With a cloud-based system, they can see everything in one place.
That's pretty incredible.
Their entire inventory updated live. This helps them make better decisions, avoid running out of stock or having too much, and really streamline the whole inventory dance.
So it's not just about convenience, it's about optimizing everything, right?
Yeah.
Reducing waste and saving money.
Exactly. And the benefits go beyond that too.
Oh.
Cloud-based systems also boost collaboration and communication.
Okay.
Everyone's on the same page. Purchasing, sales, they can all see the same real-time information, which reduces errors and improves coordination across the board.
It's like those silos within a company are suddenly broken down. Everyone's working together more effectively. Are there any other technological advancements in inventory accounting that you're excited about?
Absolutely. The integration of AI and machine learning is a total game changer. Imagine having a crystal ball that predicts future demand with amazing accuracy.
AI for inventory management. That sounds super futuristic.
It's already happening.
How does it work?
Mm.
Do these algorithms place orders automatically?
AI algorithms can analyze tons of data, like historical sales, seasonal variations, even economic indicators.
Wow.
And all of that helps them predict future demand with incredible accuracy.
So it's like having this super-powered analyst working behind the scenes, crunching numbers, and seeing trends that humans might miss.
Exactly. This level of predictive power lets companies make smarter choices about their inventory, when to reorder, even pricing.
Hmm.
It's about being proactive and data-driven, not just guessing and reacting.
So AI is taking inventory management from a guessing game to an actual science. That's amazing. And I bet this impacts those financial statements we talked about earlier, too.
You're absolutely right. Accurate forecasting leads to better inventory management, which can then boost a company's profitability. But that's not all. AI can also help optimize warehouse layouts, identify potential stock shortages, even automate routine tasks.
Wow, that frees up human employees for more important strategic stuff. It's like technology is giving companies superpowers when it comes to managing their assets.
I love that analogy, and this is just the beginning.
Really? What else is there?
We're seeing advancements in blockchain, which increases transparency and security.
Yeah, blockchain is everywhere these days.
Then there's the Internet of Things that allows for real-time tracking of inventory, like as it's moving along.
It's incredible to think about all the possibilities. But, okay, let's not get too carried away. We focused a lot on the positives of technology. Are there any challenges or potential downsides?
It's important to approach it with a balanced perspective. Implementing new systems can be expensive, complex, there are data security and privacy concerns, and we can't forget the potential for job displacement as automation takes over.
So it's not just about adopting the newest technology. It's about using it thoughtfully, addressing those challenges head-on, making sure it benefits everyone involved.
Exactly. Technology is a powerful tool, but it's only as good as the people using it.
Right.
Companies need to invest in training and development so their employees have the skills to really make the most of these advancements.
It's a lot to think about, but the potential rewards are definitely compelling. We've seen how technology streamlines those processes, improves accuracy, empowers companies. But I'm curious about the human side of things, too. How are these changes impacting the people actually working in inventory accounting?
As automation takes over those repetitive tasks, the role of the inventory accountant is changing.
How so?
Less focus on data entry and reconciliation, more focus on analysis, interpretation, decision-making, those higher-level skills.
So it's not replacing humans with robots. It's about empowering people to do more meaningful work.
Precisely. Technology is freeing up these professionals to add more value, using their expertise to analyze that data, see trends, and give insights that really drive the business forward.
It's exciting to see technology not just transforming the process, but also elevating the role of the people involved.
It's a dynamic and ever-evolving field.
Definitely.
And those who embrace technology and keep learning will be in a great position to succeed.
We've covered a lot in this part of our dive. Cloud-based systems, AI, all these advancements. But before we move on, what are some emerging trends in inventory accounting that our listeners should watch out for?
One trend gaining real momentum is the focus on sustainability and ethical sourcing.
Interesting. What does that look like exactly? How does sustainability fit into inventory accounting?
Companies are being held more accountable for the environmental and social impacts of their entire supply chain.
I see.
And that's impacting inventory accounting too.
So it's not just about the financial value anymore. It's about the entire journey of a product and its impact on the world.
You got it. We're going to see more emphasis on things like carbon footprint, ethical labor practices, responsible sourcing of materials. This means our accounting systems need to evolve. They need to capture this new information and give us a more complete picture of a company's inventory and how it affects the planet.
So it's becoming intertwined with corporate social responsibility. Inventory accounting is no longer just about the bottom line.
Exactly. This shift towards greater transparency is going to shape the future of inventory accounting and impact business ethics and sustainability as a whole.
It's really incredible to see how these ideas are coming together. We've explored how technology is changing things, but I feel like we've only just scratched the surface. There's still so much more to uncover, right?
Absolutely. We still need to talk about managing inventory costs, the problems of obsolescence, the importance of those internal controls.
It sounds like we have a lot more to discuss. Let's take another quick break, and then we'll dive into these fascinating topics in more detail. Welcome back to the Deep Dive. We've been uncovering the world of inventory accounting.
It's been a fascinating journey.
We've gone from the basics, valuation methods and all that, to the incredible impact of technology.
Absolutely.
Now, before the break, you mentioned sustainability becoming a part of inventory accounting.
Yes.
I'd love to hear more about that. What does that actually look like? How are companies doing this?
It's amazing to see sustainability becoming so important in every part of business. Inventory accounting is no different. Companies are thinking beyond just the financial value of their inventory.
Right.
They're starting to consider the environmental and social costs as well.
So it's not just about the numbers on a spreadsheet anymore.
Exactly. It's about the whole impact.
From where those materials come from to where the product ends up. Can you give us some real-world examples of how companies are doing this?
Sure. One big area is waste reduction.
Okay.
Companies are using things like lean manufacturing to minimize waste during production.
Makes sense.
They're getting creative, finding ways to repurpose stuff, recycle excess materials.
So less is ending up in landfills.
Exactly.
That's great. What other areas are we seeing this sustainability focus pop up?
Transportation is huge.
Oh yeah, of course. Moving all that inventory around.
Companies are really optimizing their shipping routes, using more fuel-efficient ways to transport things.
To lower those carbon emissions.
Yes, and they're also exploring different packaging.
Oh, interesting.
Eco-friendly, biodegradable materials.
So they're thinking about the entire journey.
From the factory floor all the way to the customer.
It sounds like a major shift in how companies are approaching this.
It really is, and it's not just about operational changes.
Oh, what else is there?
We're seeing companies include sustainability metrics in their financial reports now,
Really?
tracking things like carbon emissions from their inventory,
Wow.
water usage during production, and how much of their materials come from sustainable sources.
So sustainability is becoming part of the way they manage and report on everything.
Exactly. And this trend is only going to grow. Consumers are more aware of the impact of their buying choices, and they're demanding transparency.
They want to know where their products are coming from and how they're made.
Absolutely.
This has been an incredible look into the world of inventory accounting. We've covered so much.
I know, right?
From those fundamental principles to the latest technology, and now this focus on sustainability.
It's been quite a journey.
Our listeners have definitely gained a deeper understanding of this critical part of business.
It's been a pleasure sharing these insights.
It really has. It's clear that inventory accounting is constantly evolving,
Always changing, yeah.
driven by all these factors, technology, regulations, what society expects from companies. As we wrap up our deep dive, I want to encourage our listeners to keep learning, to keep asking questions.
Absolutely. Stay curious.
The world of inventory accounting is full of surprises. Who knows what the future holds?
I'm excited to see what's next.
Thanks for joining us on the deep dive. Until next time, keep exploring.